Hello, and welcome to a special edition of Wealth Management Insights. I'm Lisa Shalett, Chief Investment Officer of Wealth Management, and today is Tuesday, July 22nd, and I'm recording this from my office in New York City. Since the great financial crisis, the idea of American exceptionalism has been a powerful driver of outsized gains in U.S. equities. Specifically, since 2008, U.S. stocks have outpaced developed market international equities by a shocking 430% on a cumulative basis. This kind of dominance has led to the U.S. taking up an increasingly large share of global stock indices. Meanwhile, the country's economic exceptionalism has been undeniable, with superior relative GDP and productivity growth, as well as strength in the U.S. dollar. But now, a host of challenges like shifting policies, broken asset correlations, and swelling U.S. debt are adding uncertainty to this outlook, and investors are naturally asking the question if American exceptionalism may be ending. Our conclusion is that it is not over, nor do we assert that the secular bull market is doomed. Rather, our take is simply that we're entering a far more challenging time of normalization and rebalancing of complex cross-sectional dynamics. And what does this all mean? We published our thoughts on this very topic in a new special report, and we'll walk through a brief summary here in this audiocast. First, let's talk about what has underpinned U.S. dominance all these years. For one, since the great financial crisis, the U.S. has far exceeded global rivals on several fronts, including economic growth, the productivity, our pace of innovation, and corporate profitability. In stock markets, mega-cap tech leaders are dominant, cash-rich, and very profitable, with few obvious global substitutes. The U.S. labor force has also been differentiated, with immigration supporting working-age population growth. And the depth, breadth, dynamism, and regulatory rigor of America's capital markets remains unrivaled. But for all these foundational pillars, we also see factors that have flattered or supercharged the economy and markets that now seem to be reaching important inflection points, suggesting that new constraints and the consequences of past policies are now coming to the fore. For instance, there were extraordinary monetary policy responses to both the great financial crisis and to COVID. Such actions injected trillions of dollars of liquidity into the economy and kept interest rates low, and financial returns were increasingly driven by valuation expansion. Now, with such policy unlikely to be replicated, we see rates and term premiums normalizing, creating a ceiling for valuation multiples. Fiscal policy also is apt to be just as constrained as monetary policy, with U.S. debt sustainability already in question and the aggregate debt pile likely on track to grow meaningfully over the next decade. What's more, policy stimulus has also led to a misallocation of capital from excessively low rates, the surge of shadow banking, a chasm between mega-cap companies and small ones, and the massive structural imbalances in wealth and income inequality among households. Another factor that has also flattered markets has been globalization. Among other benefits, it gave U.S. companies access to non-U.S. markets, which currently account for over a third of S&P 500 profits and more than 46% of our revenues. Now we find ourselves at a time when globalization is being questioned by the new administration. While deglobalization may be necessary for national security, it introduces inefficiencies and potentially higher inflation while also pressuring the U.S. dollar. So how do all these changes affect the investment landscape? Again, we don't think American exceptionalism is necessarily over, but we do think a new investment regime is approaching. If American exceptionalism was premised on tailwinds like negative real interest rates and outsized policy accommodation, we think that's now being supplanted by an economy facing constraints and radical imbalances. Specifically, we're likely to see a new setup characterized by higher real rates, positive term and risk premiums, greater volatility, and a much weaker dollar. Finally, what does this all mean for investors? A new regime likely calls for a new kind of portfolio. For one thing, investors should be thinking about more comprehensive diversification across sectors, asset classes, and geographies. We're likely to see relative value outside of the U.S., with potentially attractive opportunities in countries like India, Japan, Brazil, and Mexico. Global yield dynamics may also foster opportunities among global financials and other cyclical industries like energy, materials, and industrials. Lastly, factors like volatility, idiosyncratic risk, and constrained U.S. policy may present new opportunities in real assets and hedge funds. We can basically think of this as the investing dynamic of the past 15 years getting flipped on its head. From a passive, U.S. growth only, private asset flattered portfolio to an actively managed, global, value oriented portfolio with more opportunities in public securities. As always, thank you for listening, and there's more information about all of this in our full special report. If you'd like a copy, or if you have any questions, please reach out to your Morgan Stanley financial advisor.